Welcome back. I hope by now you've watched the videos for the objectives 1, 2, and 3, and you've been filling out your note-taking handout. I really hope you've printed out that note-taking handout and you have it with you, or at least you're doing something to take notes as you follow along, especially for this objective. We're going to get in and start working through some of these situations, and you're going to retain so much more of the information. It's going to really click so much more for you if you'll go through it with me, if you'll look at the problems, if you'll think through them as we talk about them, and you're writing it down as we go through. Again, if you need to stop or pause the video at any time, go back, listen to that again so that you can get everything filled out. That would be in your very best interest. So we're going to actually use that accounting equation that we learned in Learning Objective 3, that assets are equal to liabilities plus equity, and go through and start analyzing some actual business transactions. So again, it's so important that you're working through these problems with me and not just trying to kind of read them or watch and as we go through it. You're going to get so much more if you are an active participant. So first of all, a transaction is anything that affects the accounting equation of the business and that we can measure. So if it affects assets, liabilities, or equity, then it's a transaction that we need to record in the records or in the books of our company. So we have two examples over here. One says we bought a computer for $2,000 cash for the office. That affects our assets. It affects our cash, which is an asset. Therefore, that is a transaction. We need to record that. The second one says we hired a new employee. That's not actually a transaction. Now, you may be thinking, well, we're going to have to pay this employee, so isn't that a transaction? Well, once the employee comes to work and really does start working for us, then you're right, then we will have to pay them, we'll owe them money, and that would be a transaction. But just the act of hiring someone, not necessarily a transaction. I don't know about where you've worked, but has it ever happened where you hired somebody or somebody at your work was hired and they didn't actually show up to work? I can tell you I've hired instructors before who didn't show up the first day of class. We don't owe them anything. They never showed up. So that's not a transaction yet. Once they come to work, then it's a transaction. So we're going to walk through several different scenarios here. And again, I hope that you're writing them down. Now, the thing is, and we talked about Luca Pacioli back in Learning Objective 3, I believe. And remember, he wrote the accounting equation, and the accounting equation has to always be in balance. And what that means is at least two things have to be affected always for the accounting equation to be in balance. If only one thing is affected, then the equation won't be in balance. So in this scenario, we're told that Sheena Bright contributes $30,000 cash to Smart Touch Learning. So we are Smart Touch Learning. We are always working from the perspective of the corporation. So for the rest of this course and most of Accounting 2302, if you take it here at TCC on the Northwest Campus, then we will be the company Smart Touch Learning. And Smart Touch Learning is going to do lots of things, but right now we're going to start off, we provide e-learning services like online trainings for corporations. So corporations hire us, we come on and do online trainings for their employees. So Sheena Bright is our owner. She has invested $30,000 of her own cash into Smart Touch Learning. In return, we give her a sheet of paper that says, "Thank you so much. Congratulations, you're an owner." We call that a stock certificate. We'll talk about that again a lot more in Chapter 13. So in this particular equation, we first need to identify what two things are affected. So cash is affected because we, the corporation, got it $30,000 cash, and equity is affected. Common stock is affected. So let's first start with cash. Anytime cash is involved, I like to, as a rule of thumb, start with cash because we intuitively understand cash. So someone handed us a check for $30,000. We have more cash now than we did before. Cash is an asset. So over here under my assets side of the equation, I have listed cash. Cash is a specific asset. And notice that it has a plus sign. It went up by $30,000. So Sheena Bright gave us cash. We in turn gave her stock. We've already said that stock is equity. Now, if the left side of the equation increased by $30,000, then in order for the equation to balance, the right side of the equation also has to increase by $30,000, right? So we know that common stock has to go up. It has to increase by $30,000. Now, you may be sitting there thinking, well, that doesn't make sense. We gave her stock. How does that make stock go up? But remember, stock is not an asset. Stock isn't like inventory. It's not like we gave her 30,000 shares of stock and now we have less stock, okay? If we had sold her t-shirts, then we would say, oh, look, our inventory is going down because we have 30,000 less t-shirts than we did before. But that's not the way stock works. Stock represents ownership, and ownership only goes up. Stock represents investment. So if you think of stock as being investment, we can say, all right, we have $30,000 more of investment now than we did before. So investment increased, therefore common stock increased, therefore contributed capital increased, therefore equity increased. I know that the stock is a hard one to comprehend, and if you'll just go with me for right now, I promise by the time we get to chapter 13, it will make a lot more sense. Now in transaction 2, we're told that we purchased land for cash. So we went out and we spent $20,000 cash to buy some land for an office. So we know that the two things affected are cash and land. Now again, I like to start with cash whenever we have cash involved. Since I spent $20,000 in cash, cash has to go down. So the asset side of the transaction, the left side of the equation, went down by $20,000. But I also got land. So now I own land, and therefore it's an asset because I own it. And so the assets are going to also increase by $20,000. So cash went down, but land went up. So overall, the equation still balances, and assets still equal liabilities plus equity. Okay. Now, I want to throw a twist in here. We said that we spent $20,000 on the land, so that's what we recorded the land at. What if we really thought that the land was worth $25,000, but we got a really good deal on it? Could we record the land at $25,000? Now, if you were sitting in the classroom, I would be looking out at you, and I'm confident that all of us would be shaking our head, no, we cannot record the land at $25,000, even if that's what we think it's really worth, because remember, all assets are recorded at their historical cost. And since what we paid for this land was $20,000, that's what we have to record it at. Now here we're told we purchased office supplies on account, and on account, you'll notice, is underlined here. That's a really key phrase, and we'll talk about that in a minute. We spent $500 on these office supplies, and we agreed to pay it within 30 days. So what happened here is the way this works. This is not something that you and I get to do as individual consumers very often, but let's say at TCC, we have an account with Office Depot, and that's where we order our office supplies from. Now, if I need office supplies, or I would go to Office Depot, or I would call the administrative assistant and I would say, hey, these are all the office supplies that I need. And then she would place the order with Office Depot and they would send me the office supplies. She would not pay for those office supplies when she ordered them because we have an account with them, because we have a deal with them. She would say, put this on the TCC account. And then Office Depot at the end of the month is going to send one bill to TCC downtown for all of the office supplies that everybody in TCC bought over the last month. And the accountant's just going to pay that one bill one time. Instead of paying 500 different bills because everybody's ordering office supplies from Office Depot, they're just going to pay one bill for the whole thing one time. So we didn't actually pay for the supplies when we bought them. We say, hey, put this on my tab, if you will. We'll pay you later, which means we did not spend cash. So anytime you see this phrase on account, you need to automatically be thinking, okay, there's no cash involved in this transaction. Since we were the buyer, we now have a debt. We now have a liability because we owe Office Depot $500. So I got my $500 worth of office supplies. I own these office supplies. So they're an asset because I own them. So I'm going to increase the asset side by $500, and then I'm going to increase the liability by $500. Specifically, this liability is called accounts payable, and we talked about this back in Learning Objective 3. Accounts payable is an account that we use to record all money that we owe to suppliers. We may have lots of accounts payable accounts. We have an accounts payable to Office Depot, and we may have a different one to a different supplier, and so on and so forth. Remember, most liabilities end in the word payable. So since this is something on account, we'll call it an account payable. So the equation still balances because the left side of the equation went up by 500 and the right side of the equation went up by 500. So here in transaction 4, we're told that we earned some service revenue by providing training services for clients, and we collected $5,500 revenue in cash. Now, part of this is that all accounting problems are word problems. So one of the things I want to try to teach you is how to read and decipher these word problems. Anytime you see the word earned, anytime you see earned, you need to automatically be thinking revenue. Revenue has to be earned. Revenue is the money that we earned from selling a good or service, but the key is that we earned it. We did work for it. So in this case, we did $5,500 worth of work. We earned it. So I'm going to record that under revenue. Remember, revenue falls under equity, and specifically it falls under retained earnings. So remember, equity is broken up into contributed capital and retained earnings is net income and dividends, and the net income is revenue minus expenses. So since I have earned $5,500, I have done $5,500 worth of work, I'm going to increase revenue by $5,500, which is in turn going to increase retained earnings, which is in turn going to increase equity. I also collected $5,500 in cash, so I'm going to increase cash on the left side of the equation by $5,500 to show that I received cash for that. But the key is we only get to record the revenue when we have done the work. Didn't matter, even if they didn't pay us right now, we would still record the revenue because we had done the work. Now, this is exactly what I just talked about on the last slide. So here we're told that we did some work for a client. We did $3,000 worth of work for a client, but we had work to deal with the client. The client said, you do the work now, and I'm going to pay you next month, okay? In other words, put it on my account, and I'll pay you later. So since we have done the work, we have earned it, we have performed a service. Anytime you see a phrase, perform a service, services rendered, delivered products, delivered goods, anything like that that implies we did work, that's automatically revenue. So I'm going to come over here and increase revenue by $3,000. Now, the customer did not pay me, so I don't get to increase cash. What I am going to do, though, is I'm going to say the customer gave me a promise. The customer promised that they would pay me, and that promise has value. If I didn't think the customer was good for it, if I didn't think they were going to actually pay me, then I wouldn't have done the work without getting money up front, right? So I believed the customer when they said, I'll pay you later, and that is going to be what we call an account receivable. Now, accounts receivable is an asset. Now, Remember, we said assets are things that we own, and I own their promise, so to speak. But remember, the other definition of asset is an expected future benefit. I am expecting to receive $3,000 in the future, and that's certainly a benefit. So I get to call that an asset. So their promise is recorded as an increase of $3,000 on the asset side. Now, let me go ahead and say something. In this transaction, it says the customer promised to pay me $3,000 in 1 month. So that was my clue that, hey, this is accounts receivable. Oftentimes you will see this written and it will say, we performed a service for clients, $3,000 on account. Okay. Now we've already seen that phrase on account, but we saw it with respect to accounts payable. We're going to use that same phrase on account when we're referring to accounts receivable also. So you have to figure out who you are in this scenario. If you are the buyer, then on account means it's an account payable. If you're the seller, then on account means it's accounts receivable. Okay. So transaction 6, we paid some expenses with cash. We're told that we paid $2,000 for the office rent and we paid $1,200 for employee salaries. So we spent cash. Cash is an asset, so that means cash went down. So over here on the left side of the equation, I'm going to decrease cash by $3,200 because I spent cash. Now these expenses that I paid, remember, expenses fall under equity under retained earnings, and they reduce equity, right? They reduce net income, they reduce profit. The more expenses, the less profit. So I'm going to treat these as negatives over here. So notice that these have negative signs in front of them, and eventually they're going to get to where we're putting these in parentheses because really we don't use negative signs in accounting, as I mentioned earlier. We're going to put these in parentheses because we are subtracting these expenses. Now, these expenses have gone up. We have more expenses than we had before, but because expenses reduce equity, we're going to treat them as negatives here so that this way the equation stays in balance. Now, here we're told that we are paying $300 on the account from where we purchased the office supplies back in transaction 3. So if you remember back, if you want to flip back in your notes, in transaction 3 we said we bought office supplies and we said send me a bill, I'll pay you later. So we increased office supplies by $500 and we increased accounts payable by $500. Now we've gotten the bill from Office Depot and we're going to pay $300 of the $500 that we owe. So I want to reduce accounts payable or subtract it by $300 to show, hey, I don't owe you $500 anymore, I only owe you $200. And since I paid cash, I'm also going to reduce cash by $300. So the left side of the equation has gone down by $300 and the right side has also gone down by $300. Now, in transaction 8, we're told that we collected $2,000 from the client in transaction 5. So if you, again, will want to flip back to transaction 5. In transaction 5, we provided services for a customer and we said, yeah, you can pay us later, that's fine. So we increased revenue by $3,000 and we increased that asset accounts receivable by $3,000. So now the customer has sent us a check. They sent us a check for $2,000. They owe us $3,000, but they've paid $2,000. So now I'm going to go in and decrease accounts receivable by $2,000 because the customer doesn't owe me $3,000 anymore. They only owe me $1,000 now. And I'm going to increase cash because they gave me a check for $2,000. So I've decreased the account receivable and increased cash. Notice I did not do anything to service revenue. Just because they paid me doesn't change service revenue. I record service revenue when I do the work. not when I receive cash. And this is one of the big differences between what we call cash basis accounting and this corporate accounting that we've been talking about. Under corporate accounting, we record revenue when we do the work. Under cash basis accounting, under you and I and our personal finances, we record it when we get paid. But now I recorded the revenue back in transaction 5. I'm not going to do anything to revenue now. I didn't do any more work, so I'm not going to record more revenue. And them paying me doesn't affect the work that I've already done. And then last thing that we're going to do here is we Smart Touch Learning decide that because we've made some profit, we've had a good quarter, we're going to share some of this profit with our owners, with Sheena Bright. And when we share some of our profit with our owner, that is called a dividend. Now, dividends don't always have to be cash, but in this case, they are. So we're going to share the dividend with Sheena Bright, which means we're going to write her a check for $5,000. Now, even though she's an owner, this check is not like payroll. Okay, we don't legally owe her any money. So corporations are not required to pay dividends. You need to know that up front. We'll talk about dividends a whole lot more in chapter 13. But right now we've written Sheena Bright a check for $5,000, and since she's not an employee but an owner, this is a dividend. So we reduce cash by $5,000 because we wrote her a check. And then over here under retained earnings, we're going to reduce dividends. Remember, dividends fall under that retained earnings arm of equity, and they reduce. We're essentially paying out of our savings account. So we're going to reduce dividends by $5,000, and we reduced cash by $5,000. So the equation is still in balance. So this is a complete look at everything that we just did, and if we were to add up all of the account balances, we would see that the assets equal 30,500 and the liabilities plus equity also equal 30,500. So our equation balances. We feel good going forward. If we got to this point and something didn't balance, we would know we had made a mistake and we got to go back and fix it, because there's no possible way for it to balance, not balance, and be correct.